This is Rod Kusin and Spooman for Risk on September 23rd, 2014, all times on the chart of Central Standard Time. Today, if you were following the premium, it gave you a beautiful setup for a short trade. At 10:12 this morning, the premium hit a new low for the morning, one of the lowest bars on the premium all day long. This is what we call a naked bar. That means that at that particular moment, the premium hit a new low. The Spoos did not go any lower, and in fact started to rally right back up. Due to the fact that this was a naked bar, it was also a bar that forecasts where the Spoos are going to come back to at some point in time in the future. And it didn't take very long for that to occur today. 79.50 was the forecasted price of the premium at that particular moment, and that means that the Spoos can be expected to return to that price, not close to it, precisely to it, or less. And that, as you can see, is exactly what took place. All you had to do is have some way to anticipate that this was the high. We'll show you how you could have known that. And then hold that trade until the price returns to what was forecasted by the premium. Now the high of that movement was up to 85.5. You could have known when to short this trade. Holding that short for a good 5 to 6 points without any problem at all. That would have been a real nice trade. Now, we're going to show you the mechanics of how you could have known that that rally should have been shorted right up here at the top. And we're going to show you some other things that we use that would identify for us the exact moment when to take that trade, and why we really anticipated that the Spoos were going to drop back to a price considerably less than this. But here's what we had on the premium once again. This new low that occurs at 10:12, forecasting return to 79.50. So, how could you have known that this price at 85.5 was overbought? It would not have been difficult if you would have used our indicators. So let's take a look. There are basically 5 indicators on this chart. There's a market profile in subgraph 1, and we have 4 other indicators that we regularly use to identify overbought and oversold conditions. Right here at 10:58 and 51 seconds on this particular chart, this red line here on the indicator in subgraph 2 showed us that we were overbought at this time. Now, there was a variety of additional reasons that you knew that as well. But on this chart, it was just as plain as the nose on your face. Very easy. You wait till this particular indicator hits 100. That's exactly what it did. It was overbought, and that's where you're going to short it. The time, 10:58. Let's take a look at this particular time more closely using a slightly different chart. Now here we're zooming in on that particular high. The chart is very similar in terms of the mechanics and the indicators that are being displayed on the chart. But we're using a slightly different time frame for this. And as a result, you could easily see that not only are we overbought, okay, We were at 100 up in here. The second particular indicator is now showing a divergence reflected by our divergence indicator, which is up here. This shows divergence. Volume is very rapidly dropping off, and we're in a negative trend on our final indicator here. So right there at 1053 specifically is where that overbought condition should have been shorted. Okay, now you could have done that as well a little earlier than what is shown at this particular moment. You could have done it right in here, or you could have done it then right here, or even right over here at that particular time. Any of these would have done the trick. But this is what we call a setup. We don't trade exclusively off of this information. We're going to look at the premium and the ticky once we have a setup. So our setup time frame was really anywhere from about 1047 all the way into 1053, perhaps as much as 1102. All right. We're going to go and show you exactly where to have taken that trade using a 5-second chart. But this is the overall picture. Here was the low. This is where we're forecasting the Spoos will return to. Here's the overbought condition. This is your setup. Now let's look into a 5-second chart and know exactly where to take that trade. Now on our 5-second chart, we have the Spoos, the premium, as well as the ticky, and a list of indicators in the subgraphs below. All of these indicators are there for a very good reason. But you can see our new low on the premium. This is a 5-second chart, mind you, and you can see that that low on the Spoos of 79.50, which takes place exactly at 10:11 and 40 seconds, is associated with a new low on the premium. This is definitely, no questions about it, a naked bar. The Spoos are going to be returning to that price. So, since we've identified that this time frame where we have our two vertical lines establishes the area where we are overbought, all right, now we're finding the opportunity to take this trade. We have superimposed four of our indicators in the lower subgraphs here, which are duplicates of what we looked at in the previous chart. And you can see on this particular indicator right here, this is where we became overbought. The indicator is at 100 right in here. And then it actually begins to drop as the Spoos move just a little bit higher. So there's your divergence. So all we have to do, once we have the setup, is to look closely at the premium and the ticky. This graph here and this graph here in the green and the magenta are specialized indicators that are placed on the premium itself. The slope of the premium is our key element. And when the slope of the premium begins to drop, indicated by a magenta color here, we know that we're into the period of time where we need to take this trade. But in addition to that, we want to look at where the ticky is. The ticky needs to be in the same posture. That is to say, the slope of the ticky should be dropping. It should be negative. On the ticky, these two graphs here and here represent the ticky, and the yellow bars represent a negative slope. So that doesn't happen until right in here, and as you can see, taking a trade right at that particular moment gets you right in at the very best conceivable price available. That's how we do it. There was another opportunity to do the same thing. When the Spoos came right back up to 85.50, which they did over here, pardon me, that 85.25. Okay, it was 85.50 here, 85.25 here. You're basically waiting for the same scenario. And as I line up my vertical bar here, you see that that's taking place right in here. Right there, we take that short trade, and down she goes. So, is it conceivable to get a fill at 85? Absolutely. Absolutely. You could have gotten a fill at 85, holding it all the way down to 79.5 or less. Okay, so there's your setup. Now, what was the Dow doing at the exact same time? Because we use the Dow as well to confirm the trade that we're about to take. This is how our charts look. We run the Emini Futures over here, and we run the Dow on a 5-second chart over here. At the exact same moment that the Spoos hit their overbought condition, right where that line is right there, at 10:53.25, this is the exact same time where our vertical line is here. Spoos are hitting a new high, and guess what? The Dow is failing. The Dow does not hit a new high right here. There is a divergence in the Dow itself. The Dow isn't quite as high as it was over here. We like that. We find that to be predictive, that there's no support for this thing going up any further because the Dow failed to make a new high. Now, a little bit later, right in here at 11:02:35, which is right here. Okay. Now the Dow does manage to make a new high, but as we mentioned previously, the Spoos fail. So while the Dow makes a new high here, the Spoos fail. There's a different type of divergence. We have divergence on the Dow at this point. Now we have a divergence on the Spoos at this point here, which correlates to this point here. Both of them are divergent, depending on which comes first. And down we go. And you can really see on this indicator here on the Dow that there's no strength there. We hit our first high here, failed to get a new high here, failed to get a new high here, failed to get a new high here, even though the Spoos are hitting a new high there. And down we go. Now, how far down was this going to go? Spoos are at 85. We'll just call it at 85. And we're going to draw your attention to our composite profile. The composite profile here can help you to know how far down this is going to go. Now, we already knew it was going to go down to at least 79.5. Now, 79.5 is right about here. But when you look at the composite profile, you realize that the low volume area is down here. And typically, when the Spoos start moving down that slope to the low volume area, they will exceed that low volume area and generally then will stop before it begins its next descent. So 79.50 was not only highly predictive, but quite short of where the low volume area was. So another couple of points could have easily been taken in addition to what the premium had forecasted. At least to 77.25, more likely to 76.25. And if it manages to drop much below that, it's going to dive toward the next low area, which is at 72. Look at where the Dow was expected to go. The Dow, keep in mind, at this particular moment, hits a high of about 17,150. Where's it going from there? So here we are at around 17,150 right in here. Okay? Your point of control, 17,095. And just like it works on the Spoos, this composite profile showed that there was a low area right here at 17,065, which is generally going to be exceeded, and it will stop sometime as it goes back up this the profile here, and stops where there's an area of greater support. In other words, a price at which the Dow spent a fair amount of time, which occurs right there at 17,057, and if not there, right in here at 17,044. Now, if it manages to get much higher than that, it'll drop down to 17,034 and think twice about going any further. But if it does, it'll stop right about there. And if not there, it'll stop right in here before it drops further into an area of lower volume. So your first stopping point would have been right in here. And you can see that on the graph. And this profile was taken back in the second week of August. Where was the low of the Dow today? The low of the Dow today was at around 17,055. And you could have seen that right here on the chart. 17,057, very, very close. So this kind of information was all you needed to have a very, very successful short trade based on what was predicted by the premium and confirmed by other market indicators that we commonly use. I didn't even bother to look at the initial balance calculation, but let's go ahead and just do that. I am a little curious. Okay. All right. Initial balance was excellent for that purpose today. The initial balance showed that the likely area of support, and this is, by the way, a calculated number. If you don't know what an initial balance calculation is, call us up, we'll describe it to you. But that calculation was 1973 and a quarter, which is the first standard deviation below the IB. So that worked out very well. And on the IND, it managed to get all the way down to the second standard deviation at 17,055, as was shown here. So again, that worked out very, very well. What about the VIX? Let's see where the VIX. Ooh, that gives you an idea as to where we're headed. All right, so you got some support on all of our market internals, the IND, the YM, the INX, and the VIX just barely makes it back to the initial balance. So the VIX in certain respects could be considered to be divergent because it didn't get as high as it was at the open. It just made it basically right back there. And so it would likely turn when it hits the first standard deviation. So you can kind of see, based on how the VIX was moving, that a good bounce can be anticipated tomorrow morning. If we drop much below where we are right now, and the VIX moves up to that first standard deviation line, which, let's just see where that number is. I'm not saying that it will go as high as 1533, in that neighborhood, 1533. But if it does get that far, a good chance that that's liable to ricochet off of that number and start to rally back up. So that's what your initial balance showed you. In any event, the market profile here shows that if we get down to 17,044 and really 17,034, I really would expect a bounce to take place at that level on the Dow, because it's not going to like having to drop much lower. If it does, however, then it could accelerate and really begin to drop, especially if it drops below 17,000 again, which is predicted. Yeah, oh yeah, that's going to happen. Absolutely. This will occur. I mean, whether it occurs tomorrow is hard to say. But if you just look at the volume profile over the last month, really, you can see there's this is an area of higher volume. We're going to get past this, and once we do, yeah, we're really going to begin to drop because there's just nothing there. There's no volume there to support it. So look for big drops in the Dow in the days ahead. So once again, a nice prediction off of the premium from this chart here. Nice new low, naked bar. Good time to take that short right up here and hold it to around 77, 79 easily. This takes it down to 77.50. You saw that on your chart, and that could have been a nice trade. However, it wouldn't have fit the overall pattern out, in that this was a short green day down with a low that could have been anticipated to have occurred somewhere after 2 p.m. And as you can see, that low really took you all the way down into the close, and even the after-hour market, it continued to drop. So coming down there into 130, double low at 145. By way of pattern, that would have fulfilled the pattern. You could see a big divergence on the premium to that point. Holding it much beyond that doesn't really get you much more. There was a little bit more to be gained, but that would have been a nice time to close up shop for the day. So anyway, give us a call at Risk. We'll be happy to go through a demo with you, show you how we analyze the market, the tools that we use, and aid you to become even a more successful trader than you are right now. It can be done. If you've been at this with little or no success, don't give up. Just get the right information. We can help you to do that. We're dedicated to make sure that you can become a successful trader, and we can give you the tools at very little cost compared to what else is out there. And the things that you had hoped that you could achieve by trading the S&P Futures is still within your reach. All you need is just maybe a little bit more help, and you can get there. So give us a call. This is RSKsys Intl for Risk.